Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Historically, REITs have outperformed the market in periods of both moderate and high inflation. Joining me to discuss why is David Grumhaus, president and CIO of Duff and Phelps Asset Management. And if now is the time to invest in REITs, it is great to have you with us, David. Welcome back to Trade Talks.
Thanks, Jill. Good to be with you.
You got it. And within listed real assets, how have real estate securities and global limited infrastructure traded in 2022?
Sure, Jill. So it's been a somewhat difficult year. I think U.S. REITs have really struggled. They're down about 30% year to date. Global REITs have been a little bit worse than that. I think for most of the year they really traded in line with the broader market, but they've definitely had a deterioration here in the last 6 weeks. Global listed infrastructure has been a bit better. Year to date down around a little bit less than 15%. Similar to REITs, we've seen a material, interest rates have really hit them hard here over the last 6 weeks. Global listed infrastructure was actually up for the year at the end of July. So, a lot of that underperformance has come here in the last couple months.
So what happened with REITs? Weren't REITs supposed to offer some level of inflation protection?
Yeah, so when we talked back in March, we had shown a chart that shown historically REITs have actually outperformed the market in periods of rising interest rates and rising inflation. I think what's happened here is just the past historical periods have really been periods where we saw rates moving up at a more levelized pace. Obviously, that hasn't been the case this year. Typically what REITs are able to do is that they're able to offset the increasing costs with higher rents. And they've been able to do that to some extent this year. But I think the magnitude of the rate increases and the interest rate spikes that we've seen has really spooked the market.
Is it the same story with global listed infrastructure?
I think to some degree, both sectors have also been hurt by the fact that you have, bonds are now a worthy alternative to the yields offered by both REITs and global listed infrastructure. For the past number of years and even for the first half of this year, you had a situation where both REITs and infrastructure, were offering yields that were 150 to 200 basis points above the U.S. 10-year Treasury. That's obviously gone away, and they're now trading at a slight discount. Now, this is much more in line with what we would see historically, but nonetheless, it has spooked the market. GLI is made up of roughly 50% utilities. Utilities for most of the year had performed really well. They were one of the best performing sectors, and investors didn't seem to be worried about the rising rates. But all of a sudden, over the last 6 weeks, the bottom has really dropped out. Utilities are down about 20% in that period. I think it's not really anything fundamental, just a big macro shift. Another subsector that has really hit GLI recently, and REITs for that matter, are the cell towers. The cell towers have been really good performing stocks over a long period of time, really good secular growth story, but not unlike what we've seen with big cap tech and growth stocks. The cost of cap, people have concerns about the cost of capital, and they're worried about this big change in cost of capital affecting valuations. And so that's really caused the cell tower stocks to trade off, notwithstanding the fact that fundamentals are still really good. They're really benefiting from the rollout of 5G.
So what's the outlook from here?
We actually think both sectors are pretty appealing at this point. We think the market is underappreciating the defensiveness that these sectors offer. One of the things I think that a lot of people are focused on are earnings, or what's going to happen. Right now, bottoms up consensus earnings for the S&P 500 still have the earnings growth in 2023 of sort of 5 or 6%. On the other hand, a recession is looking very likely. Earnings don't hold up during recessions. A lot of the big strategists at this point have taken their top-down earnings for the S&P 500 down, 10 or 15% for next year. Utilities and REITs are still expected to grow sort of 5 to 6% next year. We have a lot more faith in that growth. We think it's a lot more locked in than we do in the broader market, and we think that will make these stocks look a lot more appealing. Part of the utility sell down that we've seen this year has really been about relative valuation. The relative valuation versus the broader market got quite extended. That's really gone away at this point with the sell down. And look, if we do see a situation where the REITs are still able to grow this next year and the rest of the market is falling 10 or 15%, that relative valuation is going to look even more appealing.
Yeah, it certainly does look attractive. So it sounds like you would be a buyer of REITs right now.
Yes.
All right. Well, we appreciate the insight as always, David. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Great. Thanks, Jill. Always good to be with you.